9 trading days. That's all that stands between now and first notice day. And right now, 59,000 contracts are still sitting open, representing 294 million ounces of paper silver. Every analyst, every talking head, every mainstream commentator told us this would naturally roll off. Any minute now, right? But here's what's strange. The usual price smash hasn't fully materialized yet, even with a perfect manipulation window handed to the banks on a silver platter. Today is President's Day. United States markets are closed. Shanghai is closed until February 24th for Lunar New Year. The banks just got all the breathing room they could ask for. The clock is ticking. This is John speaking, and if this is your first video, I'm guessing you clicked with some serious doubt. Honestly, that's the right move. Don't trust anyone outright, including me. What I've noticed over time is that the people who stay aren't the ones who blindly believe everything they hear. They're the ones who came in skeptical, actually verified the sources, and found out the data checks out every single time. The establishment, mainstream banks, corporate media, the entire corrupted infrastructure, they don't want you cross-checking information. They profit directly from you staying uninformed. So if you're new here, let me clarify something up front. I don't sell anything. No courses, no mentorships, no signals, nothing. This is financial warfare education, not financial advice. I'm on X under the same handle as this channel. Handles can't be copied like names can, so verify it's the real account. I post real-time data there before it ever hits YouTube. If you're one of the people who actually checks sources and verifies what I'm showing, drop a comment below. That tells me who's really paying attention and who's just passing through. Current prices as I'm recording. Silver Western spot is $76. Futures are $76. Shanghai spot is $86. Shanghai futures are $88. That's a $10 premium holding strong despite Western consolidation. Gold. Western spot is $4,960, slipping just under the $5,000 psychological level. March, silver open interest dropped slightly on Friday to $58,770, that's 43% rolled forward to the May contract. However, with 9 days before first notice day on February 27th, a massive 294 million ounces remains open. Should even half stand for delivery, COMEX would face a substantial drawdown, with registered inventories sitting at just 90 million ounces. Here's what most people completely miss about delivery mechanics. Historical data analyzing 10 years of monthly contracts shows gold averaged 9.6% of open interest actually delivered. Silver averaged 4.9%. Recent elevated numbers have shown 13.55%, which is extreme, but the average sits closer to 10%. If we use 10% as potential delivery demand, with 20% as the extreme scenario, that's 29 to 59 million ounces against 90 million registered. Theoretically manageable. But here's the critical detail. Those historical averages were calculated during normal markets, not during the 6th consecutive year of structural deficit with Eastern buyers demanding physical at $10 premiums, showing paper and physical divergence that is accelerating by the day. Gold $20,000 call options just surged to 11,000 contracts according to exchange data, showing sophisticated positioning despite the recent sell-off. These far out of the money December call spreads between $15,000 and $20,000 are building even after the historic correction earlier this year. For this spread to expire in the money, gold prices would need to nearly triple by December expiration. Analysts describe this as cheap lottery ticket positioning, sophisticated players betting on asymmetric upside potential and using extreme strike prices as tail risk protection against potential monetary crisis scenarios where gold could spike dramatically higher than anyone currently believes possible. Warren Buffett in his famous 1998 Harvard speech called gold a metal with no utility. He said it gets dug out of the ground, melted down, buried again in another hole, and guarded by people who stand around doing nothing. He compared it unfavorably to productive businesses. That assessment has aged poorly. Since 1998, gold has dramatically outperformed the investment vehicle he built, and most equities, as currency debasement accelerated exactly as alternative analysis predicted during Stage 6 debt cycle dynamics. Bloomberg headlines during the silver crash reveal a pattern worth examining very carefully. During the worst sell-offs, Bloomberg published multiple articles about the declines. Headlines emphasized big drops, no buyers left, crazy swings with almost no liquidity. Most stories published right when prices were falling hardest in early February. On February 12th, Bloomberg ran a story claiming Russia might return to using dollars. Right after that article published, silver dropped fast from $85 to $74 within hours. Many traders noted the headline, timing scared participants and caused cascading selling. Perfect timing for anyone positioned short against silver. This pattern has been documented countless times. Large media outlets, often Bloomberg and Reuters, being used as weapons to manipulate prices through fake headlines that trigger algorithmic reactions. Now here's something extraordinary that just came to light. A Chinese fund manager is compensating silver investors after a dramatic 31.5% valuation-driven drop earlier this month. They unveiled a compensation plan addressing widespread losses from the country's sole silver futures fund, targeting investors who submitted redemption orders from January 30th afternoon through February 2nd, a period when losses were magnified by an extraordinary valuation adjustment. Investors whose incremental loss beyond the capped 17% drop was under 1,000 yuan, accounting for more than 90% of those who redeemed, will receive full compensation. The situation exposed how SHFE's 17% daily price limits impeded the fund's ability to execute exit trades during extreme volatility. Traders believe certain players with advanced information deliberately gunned for the downside once the revaluation method was unveiled, then profited by shorting global silver futures while exploiting a mechanical adjustment that was completely divorced from actual supply and demand reality. Swiss expert Jan Stuker called the January 30th crash the biggest $100 billion fraud of all time. According to his analysis, silver plunged over 30% in a single day, from peaks above 120 down to the 70s. It started right after the London fixing at 15:12 Central European Time, then dropped $26 in just 180 minutes. JP Morgan closed massive shorts exactly at the bottom after previously paying $900 million in fines for silver spoofing. COMEX ignored circuit breakers on Thin Friday trade. Paper equivalent of 1.83 billion ounces was traded that day. Zero physical metal moved. Shanghai premiums exploded to 40% plus, while COMEX crashed, showing the east-west divide widening to levels never seen before. China cracked down hard on naked shorts and banned manipulative traders with 180 cases ongoing. They did what regulators are actually paid to do. Stuker's assessment is direct. Asia will set prices as the LBMA and COMEX fade from relevance. He's targeting silver at $184 by Christmas, with a possibility of $200 to $300 on a default scenario. Physical silver never spoils. An ounce stays an ounce. Jim Rogers, co-founder of the Quantum Fund, which gained approximately 4,200% from 1973 to 1980, has one simple message. Don't sell your silver, don't sell your gold. He still owns both. He hasn't sold any. If prices drop, he hopes he's smart enough to buy additional physical during those pullbacks. He bought recently during the drops. He hopes his children inherit the stack someday. Rogers sees a gigantic amount of money printing happening all over the world. Many people are protecting themselves from currency debasement. Historically, that protection has always included metals like gold, silver, and copper. For hundreds of years, people have needed ways to protect themselves, and those metals have always been part of the answer. The historical proof extends back thousands of years. Even the biblical reference to 30 pieces of silver shows that metals have been prized throughout human civilization as stores of value during every single currency debasement cycle in recorded history. Asian markets opened with silver, knocked down $2 over just a few minutes. Clearly, a tactic to scare participants and then accumulate at lower prices. But silver recovered quickly as buyers in the Middle East and Europe came online. COMEX was actually open until noon Eastern today. Bullion bankers had the opportunity to smash prices on light volume before reopening at 6 p.m. Eastern. Reports are confirming silver is selling out in Dubai. And this is not just a social media rumor. Wealthy people in the Middle East are sophisticated buyers with agents purchasing worldwide. This represents a major force, blunting Western bullion bank silver smash attempts because physical absorption prevents sustained downside when Eastern demand remains structurally strong, regardless of what Western paper markets try to do during the Shanghai closure window. Dollar short bets just hit a 14-year extreme, according to the latest sentiment survey. Short positions against the dollar are now at the highest level since January 2012, the earliest data available. Fund managers' dollar exposure dropped below last April's lows. Concerns about Fed independence eased but failed to lift dollar demand or improve sentiment toward United States assets. Respondents cite further deterioration in the labor market as the key downside risk. This positioning extreme creates the potential for either a violent short squeeze or confirmation of a structural trend break, depending on whether economic data validates the bearish thesis or forces repositioning when reality diverges from consensus positioning and creates mechanical covering pressure. Ray Dalio's analysis of 500 years of data showing exactly how empires collapse concludes that America is now in stage 6 of 9 stages, the dangerous stage. The pattern repeats with machine-like precision every 50 to 100 years, not because of politics or ideology, but because of math. The big debt cycle has 9 stages. We are currently in stage 6, where federal debt exceeds 120% of GDP. 2 choices exist: let interest rates rise and crash the economy, or print money and create inflation. Both destroy wealth, just differently. Stage 6 is characterized by slowing productivity growth, debt service costs rising faster than GDP, money supply expanded 40% since 2020, wealth concentration at century highs, and rival powers building parallel financial infrastructure. Howard Marks wrote, "Market cycles," documenting how understanding where you are in the cycle matters more than predicting exact timing. Stage 6 doesn't mean immediate collapse, but it does mean the probability matrix has shifted towards stage 7, reset, either through massive restructuring, negotiation, or conflict. History shows wars resolve 90% of these cycles, not because humans are inherently violent, but because debts become mathematically impossible to service when internal inequality peaks and external rivals emerge simultaneously, creating conditions where conflict becomes the least bad option compared to accepting a decline that is politically and socially unacceptable. China doesn't want the United States system. It wants its own financial order with Chinese characteristics: production over speculation, society over shareholders, currency strength over endless debasement, capital flowing in, not hollowing out. The American model prioritized profit above all else. Wall Street won, Main Street lost. The real economy was sacrificed to financial engineering. China already dominates the physical economy through manufacturing, supply chains, and trade. Now it's moving to the next phase: financial dominance. For the United States, this isn't competition, it's war. Because America's financial empire is the last line of defense. Lose that, and the entire economic model breaks. This is the Thucydides trap playing out in real time, where a rising power changes the balance, and the dominant power realizes the old rules no longer protect it. India's silver imports just jumped 129%, outpacing gold as higher prices reshape trade flows, showing physical demand remains structurally strong despite Western paper price consolidation. Metals trading activity in China is skyrocketing, with combined aluminum, copper, nickel, and tin futures volume jumping 86% month over month in January to 78 million lots, 5 times the average monthly volume from the first 11 months of 2025. A wave of Chinese retail speculation is behind this rise, with metals becoming the most popular trade on social media, as Eastern participants increasingly view physical commodities as protection against currency debasement and geopolitical uncertainty. This is creating sustained demand that Western paper markets simply cannot fully suppress through derivative manipulation alone. The Dow to gold ratio currently sits at 9.82. A decline to the 2.5 historical target means the ratio falls by a factor of 3.93. If the Dow stays flat, gold must rise by that same factor, implying a gold price of $19,800, assuming the Dow holds around 49,500. That's a conservative target, focusing on the middle of the move, not a perfect bottom, because trying to time tops and bottoms only increases risk. With gold at 19,800 and a gold to silver ratio of 19, the conservative target puts silver at $1,042 per ounce. Today's starting points: gold at $5,042, silver at $77.42, gold to silver ratio at 65.13. A move to a ratio of 19 is not normalization. It's a swing from one extreme to the other, and that is exactly how silver reaches 4 digits according to the mathematical analysis of historical cycle reversals. Now let's talk about the bearish case, because intellectual honesty is what builds trust with a skeptical audience. The bank holiday creates a light volume manipulation opportunity right now. Shanghai being closed until February 24th removes Eastern physical buying pressure for 8 straight days. The historical 4.9% delivery average could simply hold, meaning only 29 million ounces get demanded from 294 million in open interest, which COMEX registered inventory of 90 million handles easily without stress. Gold, $20,000 calls could expire worthless if the monetary crisis doesn't materialize on schedule. Dollar shorts at a 14-year extreme could reverse violently and force a massive squeeze. China building parallel infrastructure doesn't mean immediate dollar collapse. Stage 6 can persist for years before transitioning to Stage 7. This is financial warfare education, not investment advice. Markets can remain irrational longer than you can remain solvent. But here's what the mechanics actually show when you look beyond the surface narrative. 59,000 contracts are still open 9 days before first notice day, despite being inside the normal rollover window, where historical patterns show a mass exodus to the next month. 43% rolled, but 57% stayed. That's a significant divergence from typical behavior. Recent delivery percentages of 10 to 13% versus the historical 4.9% show an elevated physical demand trend that's been building consistently. Even at the historical average with 294 million ounces of open interest, that's 29 million ounces demanded against 90 million registered. Manageable, but representing the tightest ratio in the modern era during the 6th consecutive year of structural deficit. China, compensating silver fund investors, exposes SHFE limit failures that created exploitable mechanical vulnerabilities for players with inside information. Jan Stucker and Jim Rogers are both emphasizing the exact same message from completely different angles. Don't sell physical metals during a gigantic money printing cycle. Physical protection has historically always worked. Asia is systematically taking price control from Western paper markets. Asian buyers are loading during every Western paper raid, treating manipulation as a buying opportunity. This east-west divergence shows physical buyers are outright rejecting Western paper pricing as a legitimate reflection of value. Dollar shorts at a 14-year extreme validate structural concerns about reserve currency status when combined with the parallel financial infrastructure being built systematically by rival economic powers. Here's what the people who verify already understand. 9 days until February 27th, first notice day. 57% of open interest stayed put despite being inside the rollover window. Historical delivery averages say manageable. But recent elevated percentages, plus 6 years of structural deficit, plus Eastern $10 premiums, plus stage 6 debt cycle dynamics, plus parallel financial infrastructure being built systematically, all suggest the probability matrix has shifted significantly. Even if exact timing remains uncertain, markets don't bottom because sentiment improves. They bottom when forced sellers are finished and supply is exhausted. Fear and emotional liquidation are mechanical and predictable. The data is clear about the setup. The outcome timing remains probabilistic, not guaranteed. Invest with logic, not hype. This is John, and I'm out.